The week kicked off with a record high for the Nasdaq, the bellwether index for the US technology sector. And the S&P 500, which tracks some of the world's largest firms, has recovered all its losses in 2020. Officials say timely government support is minimizing the economic fallout of COVID-19.
Clearly, the unemployment insurance expansion and the extra $600 a week, I think were huge because people then did not look for other jobs. They waited to be recalled, and by doing so, they helped to keep down the virus infection rates, which is what allowed people to come back safely.
Now, as states lift lockdowns, businesses are putting their employees back to work. The US economy added 2.5 million new jobs in May. Those gains brought the unemployment rate down to 13.3% from 14.7% in the previous month. The recovery appears broad-based, with 11 of the 15 largest industries reporting growth in employment. President Donald Trump says the bounce back in US equities is a vote of confidence in his economic policies.
Big day for stock market. Smart money in the world know that we are heading in the right direction. Jobs coming back fast. Next year will be our greatest ever.
Revenues have spiked for companies like Facebook, Microsoft, and Amazon as millions of people use online platforms to socialize, work, and shop during lockdowns. But many investors are also pouring money into airlines, hotels, and casinos. They hope these companies will recover quickly post-pandemic.
One of the things that's underrated and what the market did this week is not just how much it's up, it's how the average stock in the index went up. It's not just those leadership names in the FANG and the big cap tech names that were leading the way. The average stock is catching up to the index.
But the World Bank doesn't share investors' optimism. It expects advanced economies like the US to contract by 7% this year. Small retailers and service providers are forecast to take the largest hit. So while investors bet on big business, analysts say the stock surge ignores the economic turmoil affecting other companies. Mobin Nasir, TRT World.
Well, for more on the US economy, Joann Weiner joins us now from Washington, D.C. She's the director of the Applied Economics program at George Washington University. Welcome back to the program, Joann. Now, the National Bureau of Economic Research didn't really waste any time in declaring that the US economy had entered a recession in February. Normally, the body waits upwards of a year before declaring what many people already know. And economists typically wait until the end of the second quarter to declare that a recession has taken place. Why do you think it's important for a recession to be declared now?
I am only hearing part of your question, but I understood it to be about the speed with which the National Bureau of Economic Research was able to declare that the U.S. economy entered a recession in February of this year. I think it's pretty clear that when the economy grinds to a halt, a near complete halt in March, that a recession did start. I don't think that was a difficult call to make. By contrast, in the Great Recession of 2008, it took the Bureau, as it's called in shorthand, several months to declare that we actually had been in a recession already for about 6 or 7 months. So this is no surprise that they declared we're in a recession.
Now, despite the onslaught of grim economic data, we've seen Wall Street really in a feverish rally in recent weeks, and that's despite week after week of millions of Americans losing their jobs and going on unemployment benefits. Why do you think there is such a disconnect between Wall Street and Main Street right now?
That is one of the conundrums of the day, is how is it possible for the professional economist to be forecasting an annual rate of economic decline of 30 to 40%, and yet the market is up 40% on the year, certainly way up from its bottom in March. There is a handful of stocks that is driving that. I think there's actually a bunch of optimism. I also wouldn't be surprised to know that there's just a lot of day trading going on, trying to make money while we can, but also that there were fundamental issues. I mean, there was a fundamental strength of the economy before the recession hit in February. So I think there's a notion that that didn't change, unlike in the Great Recession of '08, when companies really did have debt problems. There's also an unprecedented Federal Reserve support of the economy right now, interest-free loans, and so on and so forth. So that certainly helps. The Fed is a steadying hand at the moment.
Okay, Joann Weiner from George Washington University in Washington, D.C. Thank you so much again for joining us on Money Talks.